Let's head to Nick Lardy. He is a senior fellow at the Peterson Institute for International Economics and a longtime China watcher. He joins us now from Washington. And Nick, it's great to have you here with us. Michael Holland was making the point about what we saw out of China today. His basic point, though, the important point was that he says that the Chinese are basically willing to take a risk of more growth with maybe a little bit more inflation, that is very important. Do you see it that way as well?
No, I think they're determined to bring inflation down, and I think they've been doing the right thing. They've been tightening up on monetary policy very gradually for quite a long period of time now. Yes, the headline number is at a new high over the last couple of years, but non-food inflation is still going at only 3%. Most of this inflation is food. It has been food for months. We will see a strong supply response, and I think by the third quarter, we'll see inflation coming down.
But is it significant? I think this is Michael's point, that they didn't raise rates today. They raised their bank reserve requirements. They did that, but they didn't raise rates. And he thought that was significant, that maybe the Chinese officials are willing to let it play a little bit with inflation here.
Well, raising the reserve requirement has a much more direct effect on lending than raising rates. And part of the raising rates versus the reserve requirement is also the calculation on sterilization, which relates to the buildup of their foreign exchange reserves, which, of course, they need to take sterilization measures to keep the money supply from growing so rapidly. So it's a little difficult to correlate everything, given the very rapid buildup we've seen in reserves over the last few years.
Nick, how closely can you correlate the inflation numbers that we get out of China with what we look at here in the U.S. with the 4.5% that they have in England? I mean, how much do these numbers really mean to you relative to what we are used to?
Well, I think they're reasonably accurate. The big difference, of course, is that they're all year-over-year calculations. So they're telling you that prices are up 5.5% in May compared to May of 2010. They don't do the month-over-month comparisons, so it's a little bit different. And the basket of goods is quite different. Food is relatively high in the basket because China's a low-income country, and food is a much larger share of consumption expenditures than it would be in the U.S. or the U.K.
But you like the numbers? You think we can trust the numbers?
Yes, these numbers, I think, are very accurate.
You know, Nick, I think we're really trying to get a full understanding of what's going on in China, because it certainly does impact the global economy, the global markets. You can see it today, how that upbeat news in terms of industrial production on China really impacted the global market situation. How would you describe what's going on in China? Can they control their growth, inflation going forward, or do we need to be worried about a bubble here?
I think that what we are seeing now over the last couple of months is a moderation of the pace of growth. We've seen the pace of industrial growth has ticked down 1.5 percentage points. It's still very robust, north of 13, but it's not 15 like it was a few months ago. That will bring down the GDP growth rate by, industry is 40% of GDP, so the GDP growth, the headline GDP growth number will be coming down. But I think I'm not looking to see a very sharp correction in GDP growth. We'll have a moderation in the pace of growth, which I think should be very welcome. It means China's growth is going to be more sustainable than it would be if they kept on with a very high growth, the rising inflation.
So, Nick, when we got the numbers that we did get... I'm sorry. Go ahead.
Yeah, I think a soft landing is in sight, basically, and I do not think we'll see a dramatic further tightening that would lead to the hard landing and have the dramatic repercussions that people are talking about. I certainly don't agree with what Mr. Soros said about losing control on inflation. They have broad money growth now that's running at about 15% per year. That's down very dramatically from a year and a half ago.
Right.
And 15% has been consistent with fairly rapid economic growth and moderate price inflation.
So the numbers that we got yesterday about Chinese lending tumbling in May, that their money supply is growing at the slowest pace since 2008, you're not worried? To you, that says, hey, they've got things under control. We have to expect to see some of this with the current moves that they're taking.
They're on a trajectory for, as I say, they've been converging back towards 15% for quite some time, and that continued in the monetary data we got yesterday.
So when you look at the Chinese story, what is the biggest risk at this point? Is it the political risk or what?
Well, there are two risks. One is political. There's obviously a substantial increase in unrest across China very broadly, different reasons, not connected. And I think long term, the medium term, the big risk still is that they're investing far too much as a share of GDP. 49% of GDP was the share of investment last year. It's probably up a little bit in the first quarter of this year. And I think it's in part because of the financial repression that they have. Interest rates are too low. People are going into property. Remember, the real interest rate now on a one-year deposit is highly negative and has been in negative territory on average really since 2004. And over that period, people have piled into residential property, which has gone up in price. And we know, this is a movie we've seen before.
Bottom line, you do sound pretty comfortable about what's going on in China. Nick, we do have to run, but thank you so much for your time. We appreciate it. Nick Lardy of the Peterson Institute. You bet. Take care, Nick.